Are you looking for some of the most undervalued stocks currently in the markets? I'm going to be covering 5 stocks that I'll be watching in the coming weeks. If you're interested, stick around for the rest of this video. Hi, my name is Ali, and I work in the IT industry. I've been following the markets for over a decade, and I know how scary and confusing they can be. But don't worry, I'm here to break it down into human speak. If you like this content, take a moment and hit the subscribe button. Help us reach 100 subscribers. Now let's get right into it. The first stock we're going to be covering is Pfizer. This one is a bit controversial due to the vaccine policy that some people agree with and some people don't. But we're not here to talk about that. We're going to just look at the fundamentals and some of the technicals to tell you whether this stock is underperforming or overperforming and how you can make the best of it. Pfizer just recently got approval for their vaccine shot for COVID, which was only approved for people over 65. And that's why their stock did a little bit of a rebound right here. And they've always been hitting their earnings in the last few quarters. As you can see, they're all green all the way back to, February of 2024. Now, what is the story behind Pfizer? Well, if we look at their all-time charts, you can see they've had 2 big bubbles, I guess you can call them. One is in the early 2000s, and one is during the middle of COVID. And this is because they mainly focus on vaccine policy and vaccine research. Now, we know that during COVID times, there was the vaccine push, and we saw major revenues coming from those sales. And we had a lot of sideways months until the vaccine policy started to fade closer to the presidential election in the US. Now, since then, we've seen a little bit of sideways, a little bit to the bottom, but as you can see, it's trading right now around 24.76. Now, if we look at the moving averages at the all-time levels, we can see it's trading under all of the moving averages, which is not really good. Once you get down below the 200-day moving average, typically this means that you're in a downward trend. But this is across more than close to 2 decades. Now, we're only going to focus on how the stock is doing year to date. Now, when we look at year to date, we see that the stock has not done much other than do a little bit of correction and then go back up and try to test those highs. If we zoom in a little further, we'll see that it has made some effort and it has broken through some of these moving averages. The 20-day moving average, the 50-day moving average, and the 100-day moving average. And even for a little bit, broke through the 200 moving average. Now, these are usually the bullish signs that you want to watch out for. Obviously, back in April, we saw massive purchasing from institutions. And this is a $350 million purchase. But the stock kind of took a little bit of a dip. And that's because there was a lot of controversy around whether President Trump's policies and his cabinet are going to allow vaccines to continue to be administered. Now, we saw Pfizer make sales in Europe and other areas, and this has helped it maintain its earnings. If we look at its earnings, there was almost 14 billion there, and then we had 17.3 billion there, and here we have 14 billion. So they're able to maintain about a 14 billion revenue in this market. Now, we're looking at the year with day intervals. We see that the bottoms are getting higher and the tops are also getting higher. And if you don't know what I mean, I'm talking about these points. They're getting higher and higher, and these points at the top are getting higher and higher. Now, we saw a little bit of a flattening here, but I think it's still very positive that this is trading around the 200-day moving average. So really, this is a perfect setup for either sideways consolidation or a breakout into the upside. What we're going to be looking for is testing some of the recent all-time highs of this year, which actually would be a little bit lower, just around here, around $27. Now, you might think to yourself, 24 to 27, it's not really that much. Well, it's about a 10%, but this is not the real story. Is if we can test some of these other previous all-time highs and then move further up into previous all-time highs from last year, which were around the $30, now suddenly this is looking much better. And this is looking around 24%. And compared to its all-time highs, it's actually really, really low. Given that they've been reporting a lot of money and they've been beating their revenues, they have strong cash flows, they have high dividends of 7.7%, and they've diversified their drug portfolio. I think this is something that you're gonna want to watch. If this breaks through 27 and breaks through 30, it's just gonna skyrocket from there. The next stock we're gonna be looking at is Roche Holdings, and the ticker for this, a little bit long, RHHBY. Okay, now this is not really available in the market that we're in today for some people, so you may not be able to get into this, but it is having a very similar graph as Pfizer. There was a couple of recent highs in the last few years, and then it was on a tumble, and now it's testing the waters again. As we can see, we've seen some momentum going in the upwards trajectory. They're the leading diagnostic and biological pipeline, and they have wide economic moat. So they're diversified across a lot of different regions. And we've recently seen a ton of institutional buys in this area here and in the middle of last year. So you got to follow the money. Now, if we also look at their earnings in January, they missed it by 0.1%, but they were still around 33, almost 34 billion. And recently, they've reported over 40 billion, beating it by 5%. There's another one coming in January next year. I think that this stock is going to be very, very strong. It's trading around 40.77 USD. The next one is one you don't typically hear about, which is Caterpillar Incorporated, and their ticker is CAT. Now they do trade in different exchanges. We're going to be looking at NYSE and the New York Exchange Stock Exchange. Sorry. And this one, they're currently trading around $419, so it's not a cheap stock. But Caterpillar is a massive company, and they've been on a massive tear recently since 2020, 2021. As you can see, we've seen this huge consolidation, upwards. Then we had a drop like everybody else during May, during the presidential campaign. And now we're seeing this massive upwards trend that is actually looking very well. Now, if we look at the moving averages, their stock is trading right around the 20-day moving average. And this is typically a very good indicator. Now, if your stock is trading above the 20-day average right here, it's just kissing the 20-day average. That means it's poised for upwards trend. Now, we did see a dip below that. They did miss their earnings by 3.57%, but their overall revenue was higher by about 1.64%. Even in May, they did have a couple of misses, but they're very consistent. They have structural profitability improvements coming in the next quarter. They have a very strong free cash return policy. Their cash flow is insane. And I think this, ending where it did last week, if we continue to see this moving above its 20-day moving average, we're looking for a bust out into at least the 525 range. Now, this from today to 525 is about a 25% upside. The next stock we're going to be talking about is Danaher Corporations. And this stock is currently, according to estimates, 30% undervalued. Now, when you look at this chart, you're seeing that it's had a lot of swings in the past couple of years, in the last year or two. This is where we're at over here. And we're looking for an upwards trajectory in this area, testing some of these all-time highs and the previous all-time highs. Overall, this corporation is acquisition driven. Okay, so that means they're buying other companies to stay ahead of the game instead of trying to compete with other companies. They're mainly just acquiring them instead. And they're in the top 5 positions in diagnostic tools. They're fairly undervalued in terms of their current position in this year. We're going to look at in this last year, we see that there is a lot of room for improvement in the stock. You see these higher lows and higher highs and slowly moving in the right direction. It just broke above, and it's been kind of touching the 20-day moving average. It's trading over the 50 and the 100, and it's trying to break through the 200 moving day average. Now, where this could be very, very good to watch for, if it can break through the 200-day average, what we want to see is the 200-day moving average flattening out around the 210 mark. So we want this 200-day moving average to kind of go in this direction. And then we want to see the stock break above it, and then it's going to skyrocket. And we're looking for a price target of about 280. And if it can do that from its current place, we're talking about a 35% upside. We're not going to be looking at any major explosion into like the 1x or the 100%. But I think that based on the current data, this stock is getting poised into a squeeze that's going to force it above the 200% average rate. As you can see, there's kind of a bit of a squeeze happening here between the 200 and the 20. And that typically means that there's going to be an upward scale that's going to be explosive. The next stock we're going to be talking about is Bristol-Myers Squibb. It's on the New York Stock Exchange. Similar setup to what we saw before, but this one, we're seeing some big volume from institutions, even though the earnings call was beat by quite a bit, almost 34%, beating the earnings, and the revenue up by 7.2%. And then before that, they beat earnings by 20% and revenue by close to 5%. Now here we're seeing similar, where these moving averages were recently, before April, everything shot down, they were trading above in the right area. They were trading above the 200, above the 100, and they were kind of touching within the 15 or 20 moving average lines. Here, we're seeing they're finally catching up. The 150, the 100, it's breaking out of that area, and it's trying to move above that. So what we're looking here is we need to break above $47, and then we need this 200-day moving average to come down and flatten out. And if we can see that happening, I can see this going and testing the line around $63. And then past that, we would have to see some sideways consolidation. But in the short term, I suspect that closer to this earnings call over here, where they're estimating 11.76 billion, up from their current estimate, which they beat, so we can expect this to be higher than their earnings. We really want to see this start to test the 200-day moving average. So I'm looking for this to start getting there. If we can bring the 200-day moving average to around $50 and then break out into the 63 range, that's close to a 30% breakout that you can watch out for. So really, we're looking for another squeeze. We're looking for this for this line, for the 50-day moving average and the 200-day moving average to start squeezing together so that the break can go through there. The next one is kind of a fun one. Smith & Wesson brands, obviously most famous for making guns. You can see that they've had a really bad time during this tariff war. Massive sell-off. I think the volume here, for this company is pretty big, around 7.3 million. And then we've had some, over average volumes happening. If you can see the back here, the buyers and the sellers are fighting over the stock. The sellers are slightly overpowering the buyers. They're trading well below the 200 moving average, well below the 100, well below the right around the 50, and the 20-day moving average. We're seeing some touching there. What we really want to see is this earnings call that's coming quite soon. Now, if you look at the previous earnings call, they missed, by about 7%, but they can't export, and nobody wants to buy from America if America is waging this tariff war. Their next one, they're actually estimating a negative earnings, and the revenue only estimated 79 million compared to the original estimate from just a quarter ago, more than double that. And that's because they know they can't sell weapons, they can't make shipments if this tariff war does not end. So what are we looking for? Well, we're really looking for the tariffs news. If we can keep an eye on the tariffs, if we can see some of these tariffs and these things get eased out, then we do want to see the stock come back around the 10 mark and then break through the 200-day average and start moving up. That won't happen unless the exporting issue gets resolved. Nobody wants to buy from you if you're punished. So a bit of a funny story, but something to keep an eye on. If these types of stocks rely heavily on exports, so if you start hitting some good news or some rumors about good news, start watching this types of stock, Smith & Wesson brands. They're definitely some money to be made here. If we zoom out on this, they're down bad, right? If we look back just in 2024, a little bit over a year ago, they're down 55%. So there is definitely a huge upside to this if we can get to these previous earnings that they've had in the past. Now, I'm not saying go back to 2021 when their stock wicked all the way up to $40 and back down. I'm just saying that there is, in the short term, an opportunity if we see these tariffs ease up or get canceled altogether. Ideally, the stock needs to break through the 200-day average of about $10, and then it needs to make it a support. The 200-day moving average is either going to be a ceiling, a resistance line, or is going to be a support line. So we really need to see that break through and make it to the other side. And I think that at that point, there's some nice upside to this. If it can go to, 18%, $18, that's 127% upside. The next one we're going to talk about is Emerson Electric Company, and the ticker for this one is EMR. Now, this one's had a recent breakthrough, and if we just zoom in a little bit on this, we see, when you talk about the 200-day moving average, we see down here, it was trading below this yellow line, which is the 20-day moving average. And as soon as it broke out of that, and then broke out of the next one, and broke out of the next one, we saw a massive bull run. And this happened between the months of May and August. Now, this stock didn't crash as bad as most stocks during the April drop. But if we move forward a little bit, we see now it's really testing these 100 and 200 day moving averages. So it is right below or right with the 20-day and right below the 50-day moving average. And I think there is still some upside momentum to this. What I would wait for is for this to touch down on the 200-day, do a little bit of this, and retest and start moving above the 20-day moving average. And if it starts moving above the 20-day moving average, the stock is going to be able to take off. It's set up for this. Most stocks that do this kind of movement, consolidate, up, consolidate, correction, up. This is the pattern that is most common for these stocks. And so keep watching out. I think that there is a potential for a big run for the stock. I'm guessing, this is going to have at least a 30% upside. Right around the 170. It could go further, but I feel that 170 is quite of a fair place to kind of set your sales. If this can break out above break out over the 20 and keep bouncing off it at least 2 to 3 times before it jumps the mark. Okay, we're going to look at IBM, very famous company. Everybody knows it. It has ups and downs, but obviously it's one of the most successful software companies around. Fairly large company, and what we're really looking for on this is a bounce back around the 234 mark. They just announced a partnership with AMD to try to compete with NVIDIA, Microsoft, Amazon, and the likes. We see this massive drop after hours trading right here. Okay. And we see some massive volume sales. We see a few more sales. But then this 234 line, which is the Fibonacci retracement line, right around 234, we see the bounce back. And really, this is very, very good news for IBM, because what we don't want to see is IBM under the 200-day moving average, which is this red line, which is a very solid indicator if the stock is going to be in the downwards trajectory or is going to be moving in an upwards trajectory. Most stocks under the 200 moving average start going in the downwards way, and vice versa. So right now it's at 243. We can expect the stock to do a little bit of this. And as this 200-day moving average starts to flatten out, we should expect this stock to go back. And the target that we're looking for is right around the 50-day moving average. At this point, these average lines should all meet. Okay, this right around the 260. This is the number that we're looking for. If this stock can consolidate around 260, there's some of these previous buys that happened were around the 260 mark. We see a lot of buys around that 260 mark. So if we can beat the 260 mark, this 260 can then become the support line for it to try to retrace back to its recent all-time high around 296. So from the current price, this is only about 7%. And then eventually this would be a 22% retracement. IBM is very much invested in the quantum space and AI. They even now offer courses on it. I know I'm doing a course with IBM for AI and LLM material. So if you look at the stock dating back to the 2020s, the start of 2020, it's done nothing but move in this direction. I think this IBM is going to be a very strong stock even going into the next decade. Look at their earnings charts. All of these earnings were beat. There is not a single red earning in the last 1, 2, 3, 4, 5, 6, 7, 8 quarters. That's a very solid fundamental. And we covered some of this in the video that we put out today, or yesterday around people just passively investing in companies without really thinking about the fundamentals. And if they perceive the stock to be weak, they're not going to put their money into it. But the company fundamentals of IBM are solid. I think it's going to be a massive competitor in the long term over the next decade in the quantum and AI space. The partnership with AMD just makes it that much easier to achieve. AMD wants to test its new AI chips. IBM wants a solid partner that's not NVIDIA. They want to work with someone that's willing to give them a break on prices and give them the infrastructure to run their AI models and give places for people to get cheaper quantum minutes from their machines. And I think that this is going to be a massive play. It's going to take a few years. If you're an IBM believer, I think this is a great time to buy. I don't see the stock going below 234. I think that's probably the minimum it's going to ever hit, and it's only going to go up from there. So something to really look into. Obviously, this is not financial advice. You got to do your own research, but it's a solid stock, not because of the stock itself, but because of the underlying asset that is the company and their AI vision. Definitely one that I'm keeping a very close eye on. We're going to look at Cummins Inc., famously for making engines, natural gas, ethanol, and diesel. Recently, they've had some good momentum. Starting in around July, they've started crossing the 20-day moving average in their stock, and it has shown upwards trajectory. Now, during this period in August, we've seen some top executives sell a few million shares because they're beat their all-time highs, and there's nothing wrong with taking some profits. But recently also, Cummins is signing a joint venture with Vale and Komatsu Advance to build a new type of engine that's powered by both ethanol and diesel. And that should be an interesting endeavor. Their core business is still facing headwinds from the tariffs, but they're breaking out into the AI space. And I'm not talking about them getting into actual language models, but they are supplying power to power units to data centers that are AI driven. And we all know that the AI industry has had, some would say, the most investment in history out of all different types of industries that we've come across in the last few decades. But the return on investment is very far away. So Cummins is, in my opinion, trying to diversify its sales portfolio because they're seeing a lot of headwinds with the tariffs, and they're thinking that maybe we can continue to deliver earnings and revenue even though we have this headwind of tariffs. If we look at their last several quarters, about the last 7 quarters, they've beat their earning calls, and it's very promising that their numbers continue to be steady, maybe not exaggeratingly higher than they want, but their latest one, their earnings was almost 23% higher, which is very good for the company. And that's when we really start to see some of this upwards momentum. Last one, before this one in May, they had a 21.5% earnings beat. And then the one right after that, almost a 23% beat. And this is where we see this upwards trajectory moving above the 20-day average, 20-day moving average. I think that this stock is poised to break out as we see more and more investments in the power side, which can return short-term return on investment because they're not really into the AI space itself. They're in the support structure of these data centers. So they don't care if AI makes it or not. As long as they keep selling power infrastructure to these data centers, their return on investment is going to be a very short timeline. If we zoom out, when in doubt, zoom out. This company has had nothing but success over the last decade. They've had some downs like everybody else during the pandemic, but otherwise, we're seeing a very nice upwards trajectory. And without outside factors like the U.S. elections and COVID. And even in previous year, in around March, we saw this massive volume of companies buying and selling, but the buying pressure did beat the selling pressure, as we saw continuing throughout this timeline here. So I think that we need to seriously keep an eye on this stock because it is poised for a run. It's been doing some nice consolidation, slowly edging its way over the 20-day moving average. I think that it's going to be going in the upwards trajectory regardless of AI is or isn't going to be a good return on investment. As long as they keep diversifying their product line and not just relying on their traditional core of engines. Very interesting company to keep an eye on. Thank you for watching until the end of the video. If you found this enjoyable, please consider watching other videos on my channel or drop a comment below and let me know what other videos you would like me to make. Stay safe, stay diversified, and I'll catch you in the next one.